So, what will the stock market do in 2026? It's the million-dollar question, right? Well, what if I told you there's a really strong data-backed case for a bull market? We're going to walk through that exact forecast piece by piece. Let's dive in.
To figure out where we might be headed, it helps to look back at where we've been. Cast your mind back to early 2025. The mood was not great. Pessimism was everywhere. You couldn't turn on the TV without hearing some expert warning about a crash. This quote from back in April, it pretty much sums it all up. The feeling was that a bear market wasn't just possible, it was pretty much a done deal.
And yet, what actually happened? The S&P 500 finished 2025 up 17%. That's a huge disconnect, right? And look, this isn't about pointing fingers at forecasters. The point is predictions are hard. It's a really crucial theme for our whole conversation today. We have to look at the underlying data for ourselves, not just the headlines.
Okay, so here's our game plan. First, we'll touch on why those 2025 forecasts missed the mark. Then, we're going to zoom out and look at the market's long-term historical trend. And that's going to set us up for the main event, the 6 big reasons for optimism in 2026. After that, we'll wrap it all up with a quick summary and, of course, a look at the risks.
All right, let's get into it. Section 1, Forecasts versus Reality. Look, before we can even start to think about 2026, we've got to understand why so many people got 2025 so wrong. Again, not about blame, it's just a really good reminder to focus on the actual evidence over just, the popular opinion of the day.
Okay, so that leads us right into Section 2, History's Upward Bias. Now, before we try to predict what's going to happen in one specific year, our source makes a really important point. We need a baseline, a starting point. And what's the best baseline we have? Well, it's decades and decades of history. So, let's take a look. What does that long-term trend actually tell us?
And this is pretty amazing when you see it laid out like this. The consistency is just wow. If you look at 74 years of data, all the way from 1951 to 2024, the market finished the year in the green 58 times. 58! That works out to a staggering 78% of the time. The bias, pretty clearly, is upward.
So here's the key takeaway. We're not starting from a coin flip, a 50-50 guess. The starting point, the historical baseline, is a 78% chance of gains. So the real question for 2026 isn't just, will the market go up? It's, do the conditions we see right now make the odds better or worse than that historical average? That's the framework.
And that question leads us directly to the absolute core of this whole explainer, the 6 pillars of optimism. These are the 6 main arguments our source material lays out for why the odds for 2026 might be even better than that already strong 78% baseline.
So what are they? Well, we've got a strong U.S. economy, a supportive Fed policy, really strong corporate earnings, some fiscal stimulus in the pipeline, an uninverted yield curve, which is a good thing, and just plain old technical market strength. Let's break them down one by one.
All right, first up, pillar number 1. The U.S. economy is just surprisingly strong. For years we kept hearing about a recession that was just around the corner, but it never showed up. Instead, the economy just kept on chugging. The source points to the third quarter of 2025, where GDP growth hit 4.3%. That was the best it had been in 2 years, and it's all because people kept spending. And since consumer spending is basically the engine of the U.S. economy, that is a really, really bullish sign.
Pillar number 2 has to do with the Fed. They're now kind of seen as a friend to the market, but it's a little more nuanced than that. See, when the Fed cuts interest rates because they're scared of a recession, that's actually been a bad sign for stocks. But when they cut rates while the economy is strong, which is exactly the situation we're in now, our source says that's been incredibly bullish. We're talking positive returns in every single one of the 22 times it's happened since 1980.
And there's more. On top of that, the Fed also stopped doing something called quantitative tightening, or QT. Basically, that was their process of pulling money out of the economy. So think about it. Now you've got rate cuts putting money in, and you've stopped the process that was pulling money out. According to the source, that gives us 2 powerful tailwinds, pushing the market forward.
Okay, this brings us to pillar number 3, and this one is huge, corporate earnings. Because let's be honest, at the end of the day, stock prices follow profits. And the projection for 2026 is that S&P 500 earnings are going to jump by a very healthy 15%. A lot of that is being driven by the productivity boom from AI, which is flowing right down to companies' bottom lines.
And this is a great breakdown of where that growth is coming from. Yeah, the big tech giants, the Magnificent Seven, they're expected to see earnings grow by almost 23%. But here's the really important part. The other 493 companies in the S&P 500 are also expected to post strong double-digit growth of over 12%. So this isn't just a handful of companies, it's really broad-based strength.
Pillar number 4 is all about fiscal stimulus. The source material points to a few government policies that it sees as being really bullish for stocks. We're talking about things like deregulation, making mergers and acquisitions a little easier, and some pretty significant tax cuts. We're looking at about $137 billion for corporations and another $100 billion for households. All of that money gets pumped right back into the economy.
Okay, for Pillar 5, we have to look at the bond market. For the longest time, it was flashing this big red recession warning sign called an inverted yield curve. All that means is that short-term bonds were paying more than long-term bonds, which is kind of backwards and shows a lack of confidence. Well, good news, that's fixed now. The curve is back to normal, and Treasury yields are right in what the source calls the sweet spot for stock prices. So that's another check mark for the bulls.
And the sixth and final pillar, it's just simple momentum. We're now heading into the fourth year of the bull market that kicked off back in October of 2022. And you know what history says about the fourth year of a bull run? It's almost always positive. The market finishes higher 85.7% of the time. That's even better than the already great 78% average we talked about earlier.
All right, we just went through all 6 of those pillars. Let's take a breath and put it all together. What does this full picture actually look like for 2026?
So here's the whole case in a nutshell. You've got a strong economy, a friendly Fed, booming earnings projections, new government stimulus, good signs from the bond market, and powerful historical trends on your side. I mean, they're all pointing in the same direction. It's a really compelling, layered argument for being optimistic.
But you know what's coming, right? No forecast is ever complete until you look at the other side of the coin. A case this strong feels great, but investing is never, ever that simple. We have to ask that all-important question: what could go wrong?
And that leads us to this final, really critical question. After hearing all of that, with 6 powerful arguments all lined up, does that mean a rising market in 2026 is a done deal? Is it basically guaranteed?
Well, the answer is, of course, no. In the market, nothing is ever guaranteed. What we've just walked through is a really powerful bull case, for sure, but every single one of those pillars has a potential counterargument. I mean, what if inflation comes roaring back and forces the Fed to pivot? What if some geopolitical event throws a wrench in the works? These are the kinds of risks that form the bear case. And while that's a deep dive for another day, the big takeaway here is this. The data makes a compelling argument for optimism, but a smart investor always weighs that optimism against the very real risks that are always out there.